If I were to ask my grandmother if borrowing money from a life insurance policy was a good idea, she'd probably tell me, hell no, Carlton. She'd probably warn me that borrowing money from a life insurance policy would cause it to lapse. If I was to ask a financial advisor like Dave Ramsey if borrowing money from a life insurance policy was a good idea, they'd probably tell me, hell no. They'd tell me I'd be a fool to save my money in a life insurance policy and then have to pay interest to access my money to the life insurance company. They'd probably advise me not to do it. But if I had the opportunity to ask somebody like Walt Disney if borrowing money from a life insurance policy was a good idea, he'd tell me that in the 1950s, when no banks would loan him money to finance his dream of building Disneyland, he went to his cash value life insurance policy, and that's the money he used to build Disneyland. If I had the opportunity to ask somebody like Ray Kroc if borrowing money from a life insurance policy was a good idea, he'd tell me that during hard times, he accessed his life insurance cash value to pay franchise fees and employee salaries, and McDonald's probably wouldn't be what it is today if he didn't have access to the cash in his life insurance policy. You see, depending on who you ask, borrowing money from a life insurance policy is either a great idea or a horrible idea. Today, we're going to talk about why I believe borrowing money from your life insurance policy is one of the greatest things you can do to access cash. So like, share, subscribe, and let's get into it. Listen, life insurance should be an essential part of our wealth building strategy. We should be using life insurance to build our own banks so we can remove our dependence on traditional lending institutions. We don't want to have to go to a bank for access to cash. We should be able to access cash using our life insurance policies. So, how do you access the cash from your life insurance policy? The most efficient way to do it is through a policy loan. Now, if you ask around, you have a lot of different opinions on policy loans. I think the issue is people don't truly understand how life insurance policy loans work. So let me use an example to try to break down in its simplest form how a life insurance policy loan works. I want to compare it to a 401k loan because I feel like a lot of people understand how 401k loans work. So let's say John has $50,000 saved up in his 401k, and let's say he also has $50,000 saved up in his life insurance policy. John wants to go get a car that costs $30,000. The dealership tells him no bank will give him a loan. John's okay with that. He's going to borrow his own money. The question is it better to borrow the money from his 401k or his life insurance policy? Let's talk about what happens in both situations. If he borrows money from his 401k, then his $50,000 account balance is going to drop by the number he's borrowing. If he borrows $30,000 to buy the car, John's $50,000 401k drops down to $20,000. What's happened? He's disrupted his compound interest. The money he was earning in his 401k now gets disrupted. He's no longer earning compound interest on $50,000. John is now gaining compound interest on the remaining $20,000. And he's most likely going to have a repayment schedule, right? They're probably going to take it out of his check if he gets 401k through his employer, and he's going to have to pay back into that 401k to make sure his balance goes back up and he continues his compound interest and he can have a great retirement. Now, what happens if John borrows from his life insurance policy? I think the biggest confusion that people get when it comes to their life insurance policy loans is that they think they're borrowing from their life insurance cash value the same way they would from their 401k. That's not what's happening. When you borrow from your life insurance policy, what's actually happening is the life insurance company is giving you their money. So while some people think, well, it's a horrible idea to borrow my cash and my cash value and have to pay interest on it, they're not understanding that you're not borrowing your cash. The $50,000 in John's life insurance policy has not been touched. The life insurance company has given John $30,000 as a loan, and they're going to charge him interest. Most life insurance companies charge between 5 and 8%. So let's say that the life insurance company says, John, We know you have $50,000 in cash value with a policy. We're going to use 30,000 of that as collateral to give you a $30,000 loan at 7%. The life insurance company has no problem loaning John this money. Why? Contractually, the life insurance company has to pay John a guaranteed rate of return every year. Let's say it's 4%. The life insurance company has to give John, no matter what, 4% on his full cash value, his $50,000. So they don't mind giving John a loan of $30,000 at 7%. John is basically doing their work for them. So it works out for them. It works out for John because he doesn't have to go to a bank and ask them for money. He doesn't have to go to his 401k and stop his compound interest. His whole $50,000 can continue to gain 4% from the life insurance company while he has this loan out. And even better, there's no repayment schedule. The life insurance company wants John to keep that loan for as long as possible because for as long as he has that loan, they don't have to worry about making sure they pay him that 4% on that $30,000. They're getting paid 7% on it. But there's something even better. If John is with a mutual life insurance company, they have the potential to pay John a dividend. A dividend in a life insurance policy is a return of premium. If the life insurance company was profitable and everything went well that year, the dividend is declared at the end of the year. So the life insurance company may say, hey, we had a great year. We're going to pay you a 6% dividend. So if the life insurance company pays John a guaranteed 4% on his full cash value of $50,000. And at the end of the year, everything went well for the life insurance company and they declare a dividend. They're going to pay him 6% on his full $50,000. With the guaranteed 4% and with the dividend of 6%, that's 10% that the life insurance company is going to pay John on his full $50,000 cash value. So let's pay attention here. I want you to truly understand what's going on here. John has gone to his life insurance company and requested a loan for $30,000. Without question, the life insurance company has given John a loan, direct deposit into his account within a matter of days for $30,000 and has asked him for 7% interest every year for as long as that loan is out. While this is happening, John's $50,000 and his whole life insurance policy cash value will still gain the guaranteed 4% plus the potential to earn a dividend. This is continued compound interest, even though you've got access to your cash. There's no better way to access your money. This is why building your own bank and borrowing from a life insurance policy is one of the best ways to access money. There's no need to disrupt the money in your 401k and stop the compound interest and have your account balance decrease in the amount of the loan you took out. There's no reason to go to a bank and go through the stressful rigmarole they put you through to borrow cash. They want to know what you want to do with it. They want to run your credit. They want to tell you to pay down credit cards. They want to know your debt to income ratio. You don't have to deal with any of that. You request a loan from your life insurance company. They'll give you that money in a matter of a couple days. This is the beauty of a life insurance policy loan. And if we truly understand how they work, then we will truly understand why we should be using them. Like, share, subscribe, follow the channel.